Hello everyone, Clifford Bennett, Chief Economist at ACY Securities. Well, interesting developments. Gold and oil did have a bit of an overbought price consolidation to correction. It's a bit hard to use the word correction, but certainly consolidation. And I still think they're going higher because unfortunately the situation in the Middle East, I noticed some headlines today in the Asian region as saying the equity market in the US rallied because of diplomatic hopes. There's not a lot of diplomatic hope at this point.
Hi traders, and thanks for watching. We'd like to take this opportunity to thank our incredible viewers for tuning into our channel. We would greatly appreciate it if you could hit that subscribe button, as we're pushing for the 10,000 subscriber mark by the end of the year. Now back to the video.
Unfortunately, and I was initially thinking this would remain contained, but the humanitarian disaster is of such extent and nature and basically all-encompassing, and it's also it's a crisis on both sides, but the intensity of the pain being experienced by both sides suggests that it's going to be very difficult for either side to back down at all. And let's face it, peace only comes when one side begins to be willing to back down. And that just isn't occurring in this situation. And it's also so intense and painful for so many people that it's becoming more probable that other parties may be drawn into the conflict. And we're also already seeing skirmishes with other parties. So I would have to suggest that the geopolitical risk remains heightened to extreme, and that gold and oil therefore will continue to be very highly sought after commodities as some kind of safe haven and point of security in the midst of all that is going on. So yes, some consolidation in gold and oil, but I do think they will be going considerably higher in the days, weeks, and even months ahead. As you know, I was already bullish gold and oil in any case for other fundamental reasons, and those fundamental reasons remain in place. That is that in the case of oil, there's been so little investment over the last 10, 15 years in that industry due to the focus on renewable energies. It's been a neglected energy source, and therefore it is one where the producers, of course, now have even greater pricing power than they did 10 years ago. So a range for oil up towards 96, perhaps breaking as high as 107, 108. And for gold, I foresee $2,400 within 2 years. But if there were an escalation of the Middle Eastern conflict or a reheating in the Ukraine-Russian region, then I think gold could move very quickly, perhaps in 12 to 18 months to those kinds of levels. So very bullish both those commodities. In the midst of a still troubled global economy and with ever greater geopolitical uncertainty, again, consumers and businesses in a global trend, but particularly in Western and regional economies of the Middle East, will be rather cautious in their spending, both consumers and businesses, as I said, and that points to a further economic slowing. Also of note around the world of late is a very sharp fall off in both imports and exports for many trading nations. This suggests that the global trade slowdown is intensifying, not plateauing, and that means a depressed global economic outlook moving forward. Not a depression, but certainly very modest economic growth. And for the world, anything below 3% is really viewed as a recession in terms of its impact. So I think, global economic growth could even skirt with flat to negative in 2024, as inflation will not be going away. And it could even get back above 4% in the US by year end. The Fed may even still be hiking rates in the first quarter of 24. The US economy is still troubled. We saw New York Empire manufacturing index come out overnight, and that indicated a further contraction of the manufacturing sector there. And I was looking for some stabilization of the manufacturing industry, albeit at very depressed levels, but at least some stabilization. But more recent data over the last week is suggesting to me that I might be, and I'm among the biggest bears, I might be a little bit optimistic on that, and there may be a heavier landing still in store for the manufacturing industry in the United States, and housing prices in the United States are likely to come under increasingly downward pressure. There is a lot going wrong in the US economy, and that suggests a very cautious outlook indeed for the US stock market. So I remain very cautious to bearish and see current strength as safe haven flow perhaps to US equities, but I do not think that rally can persist, and I would suggest caution across the equity markets, bullish gold and oil as I said, and the US dollar being a little bit schizophrenic at the moment, split personality between the bullish factors of ever higher yields, which I've constantly forecast, and of course safe haven buying, and of course don't forget, if you're a major global corporation and you have a US entity, you can park all of your cash reserves in one of the too big to fail US banks, and the US taxpayer will guarantee all of your deposits fully. And that has certainly played a part in capital flows to the US over the last 6 months or so. So they're the bullish factors. The bearish factors remain a very dysfunctional US economy. I mean, the only data that says the US economy is strong is consumer spending, and retail sales are very mixed. Consumer spending and, of course, the employment data. But the employment data ignores there's still over 2 million workers who never returned from COVID. So it's a smaller workforce showing strong employment numbers. And also the consumer spending data is not inflation adjusted. And really a lot of that masks the fact that consumers are most definitely cutting back. The US economy continues to split in two between the wealthier and the working struggling sector. And the working struggling sector, I would suggest to you, is the majority of America at the moment. Small business sentiment is at crisis levels. Consumer sentiment levels, as I mentioned, has just come out at GFC and has even been lower in the past year and is falling away again. And we've had a manufacturing recession all year long. So the outlook for the US economy is not strong. The outlook for the Chinese economy is not strong. The outlook for the EU economy is not strong. And we have heightened geopolitical risks in the Middle East. So this is not a rosy, bullish fundamental outlook for the US stock market by any means, because there's no rescue coming either from strong economic growth elsewhere in the world or from the administration, which has its head in the sand, claiming the US economy is the strongest economy in the world, which of course it's not. And also the Federal Reserve having a blanket approach to inflation, keeping interest rates higher for longer. And as I said, could be another 1 or 2 or even 3 rate hikes there. If oil were to continue to climb higher, you will have US inflation above 4%. The Fed will be hiking again. So all of this works against the US society in general and the economic Main Street. Wall Street likes to be detached and thinks somehow it lives in a different, more refined, aerified world than the rest of us. And by the way, I used to be one of them. I've worked for leading the biggest investment banks in the world in London and Paris and Singapore, Tokyo and New York. So I do know how those creatures operate. And it's really a very significant thing at the moment, the detachment, if you like, of the Wall Street ivory tower types and those who want to be like them around the world from the reality of what is going on in Main Street USA, Main Street Europe, and Main Street China and other parts of the world as well. So global economic slowdown to intensify, creating even more trading and investment opportunities. Thank you very much, Clifford Bennett.